Hello, everyone. This is Alan Hawley, Digital Media Manager here at Ncontracts. I wanted to pop in really quickly just to let all of you know that the Ncast will be going on an extended break as the team here looks into developing new, exciting content and formats to deliver to you all. No exact date yet on when that relaunch will be taking place, but be sure to follow Ncontracts on LinkedIn, Twitter, and Facebook to stay up to date on when you can expect exciting new podcast content from us. So stay tuned, and thank you for listening.
Welcome to the Ncast Monthly Regulatory Brief. I'm Aileen McDonough, your host and Director of Content Marketing at Ncontracts. In this podcast, our compliance team provides an overview and analysis of the latest regulatory changes for financial institutions, along with info on trends to help you keep up with the rapidly evolving nature of compliance. Let's get started.
Thank you for joining us to talk about regulatory changes, guidance, and news that have happened during the month of May. The month of May was not as active and busy as the month of April, but we still saw some pretty important guidance out there that we think you should be aware of if you're a depository institution, a non-bank, or even a fintech. So today, we're going to be issuing this Ncast with my colleagues Nicole, Upshur, and Robert Brosh, both regulatory compliance counsels here at Ncontracts. My name is Stephanie Lyon. I am the VP of Compliance, and we're going to start with something very important when it comes to language preferences and how you can treat people fairly, even if English might not be their first language. So take it away, Nicole.
Okay, thank you, Stephanie. Well, the Federal Housing Finance Agency announced that Fannie and Freddie Mac will require lenders to use the mandatory Supplemental Consumer Information Forms as part of the application process for loans that will be sold to the enterprises. The purpose of the SCIF forms are to collect information about borrowers' language preference and on any home buyer education or house counseling that the borrower receives. So lenders can better understand borrowers' needs during the home buying process. This FHFA initiative is part of a more expansive initiative that the CFPB and other federal regulators have expressed, which is the importance of ensuring fair lending in the industry. For instance, the CFPB also has released model Spanish language translations of the Reg E forms. The CFPB is providing these model and sample Spanish language forms to help lenders better cater to their limited English proficiency borrowers. And this initiative comes on the heels of the CFPB's May 16th Mortgage Servicing Metrics Report. So that report detailed the CFPB's observations from data that they collected over 16 servicers from May to December of 2021. So the report that came out in May showed that data for English proficiency borrowers, that they face negative disparities with lending opportunities compared to their counterparts. For instance, the data showed that the number of LEP borrowers whose loans were delinquent without a loss mitigation option after they exited forbearance increased between October and December of 2021, while the number of non-LEP borrowers who were delinquent without a loss mitigation option after forbearance decreased during the same period. So that clearly shows the disparity. The CFPB is now encouraging servicers to enhance their data collection and retention of borrowers' language preferences to improve communication and servicing for LEP borrowers and to maximize home retention opportunities for LEP borrowers exiting forbearance. The CFPB also is encouraging servicers in this report to assess and identify any potential differential treatment or outcomes associated with race and LEP status as part of ensuring that they take measures to prevent lending discrimination.
Thank you for that, Nicole. And that's really interesting data. So I can definitely understand why they keep releasing these model forms to help out. We're going to go ahead and move on to the Cfpb Supervisory highlights. Robert, I know there's a lot that the Cfpb is focusing on. So what are they telling us in their guidance?
Yeah, you're right, Stephanie. It does cover a ton, right? Focusing on a range of topics. They talk about debt collection, credit reporting, auto loans, credit cards, money transfers, deceptive practices, basically the whole kit and caboodle there. And so I want to touch on a few of the big ones to keep in mind moving forward based on these reports, because definitely, as we know, it's never one and done for our regulators. And so if they're touching on it here, it's definitely something that they are going to pay attention to in the future and make sure that institutions are making changes. And so the first big one is auto loans. And the first thing that they mention really is repossession. And so just as a reminder, a repossession cannot occur if a borrower has taken intentional action to prevent repossession, such as making sufficient payments or entering into a payment plan with your institution. And then the second thing they touched on with auto loans was the additional add-ons of gap insurance, for example. And they remind, institutions, when you do add on an additional product to an auto loan, such as gap insurance, you definitely have to refund any unearned fees and also refund those fees, after a repossession has occurred or after the loan has been closed out. And the other big one from these supervisory highlights, again, it pops up in the news all the time, is credit reporting. The CFPB found that furnishers were committing various violations of the FCRA, but the big ones included reporting indirect disputes as frivolous, which is not permitted under the FCRA. And just as a reminder, an indirect dispute is a dispute from a consumer directly to a consumer reporting agency, not to your institution as a furnisher. And then another was that furnishers were failing to correct and update information reported to those consumer reporting agencies after determining either that the information was incomplete, that it was inaccurate, or making a determination that it didn't match up with the information on a furnisher's own systems and the accounts that they have, which definitely leads right into the requirement that your institutions as furnishers, if you do furnish consumer data to those CRAs, you definitely have to have reasonable written policies and procedures. It is a regulatory requirement to ensure the accuracy and integrity of that information. And so definitely now is a great time, if you haven't in a while, to review those policies and procedures and make sure they operate, as both your institution intends and as well as compliance with those regulatory requirements. Again, supervisory highlights touches on a wide variety of different topics. However, those were the big ones that they really honed in on for this past report.
That makes sense, Robert, especially because the number one consumer complaint is around credit reporting. And we saw a huge spike during COVID and the pandemic. So I can see why the regulators are definitely focusing on that. We're going to go ahead and move on to different regulators here. So we're done with the CFPB for a little bit, not for the entire Ncast. And one of the things that we are looking at is the new guidance that was issued by the Department of Justice, the DOJ, and the Equal Employment Opportunity Commission, which is the EEOC. Between the DOJ and the EEOC, they regulate the employers at both the private sector and government sector. So this does apply to financial institutions as well. And in their guidance, they're telling us hey, we see a lot of new technology, AI being utilized to hire individuals, and that's fantastic and all. However, don't forget that the use of these technologies could also allow for discrimination on the basis of disability. And that's not the only thing we have already seen these types of algorithms do and discriminate against, but they are focusing on the prohibited areas. And this specific guidance that was issued in May had the focus on disability. So what are some things you can do as a financial institution if you're employing the use of AI, machine learning, any special or specialized technology during your hiring process? There are two things to consider. One, you want to make sure that whatever you code into the algorithm, whatever the AI is looking for, it has nothing to do with a disability. It has nothing to do with gender. It has nothing to do with familial status. All of those prohibited bases, make sure your AI is not rating applicants based on any of those things. That's number one foremost. The second thing is, if you are utilizing it during the hiring process, it's really reasonable to let your applicants know what kind of technology you're employing. Because if you're utilizing it to do skills tests, technical interviews, or just during the resume review process, you have to make sure that if the applicant has a reasonable accommodation or they need one of those, that you can provide it to them and you don't use that information that they need a reasonable accommodation as any basis or as as an impediment for them getting the job. So those are really the big things from the guidance, and the FAQs is just beware if you're utilizing it. And we have seen examples of this technology causing discrimination in the past. You may remember Amazon, they actually produced their own algorithm to go through resumes. And in the end, they coded it in a way that the system started to look at gender and made preferences for white males over females. And of course, they immediately took it down when they found out that there was this huge disparity in the types of applicants that they were selecting. One last thing is, as always, when it comes to making accommodations, reasonable accommodations, you do have that additional layer there, which is it should not cause an undue burden on your institution. So there are two ways to look at it and things you need to consider. So that is the DOJ and the EEOC. We're going to move on to issues affecting depository institutions. And this time we're going to start with flood insurance. You can never stop talking about flood insurance because it's complex. It changes all the time. But thankfully, the regulators are giving us some clarity, and Robert's going to tell us what they're giving us.
Yeah, so you could say that the agencies have really flooded institutions with a lot of flood insurance information. The FRB, OCC, NCUA, and FDIC, I think that's the one that I forgot there in that list, did just revise their joint flood insurance frequently asked questions. What they did with that was they consolidated FAQs that were released in 2009, in 2011, and then proposals in 2020, as well as 2021. Right. So your institutions, if you are one that makes residential mortgage loans in a special flood hazard area, you have a lot to keep up with. And it's been tough over the past decade because information has been scattered throughout a variety of sources of regulatory guidance. But really what the agencies are trying to do here is consolidate everything down into one place, create a logical flow of information so that way it's easier for your institutions to find answers to questions concerning flood insurance. And so that reorganization should make, again, an easier flow. And in particular, the FAQs do address a lot of the regulatory changes that have occurred over the past decade, right? These FAQs address when flood insurance premiums have to be escrowed, what detached structures are exempt from mandatory flood insurance, proper forced placement insurance notification requirements and amounts, as well as, one of the most recent rules requiring institutions to accept private flood insurance policies that meet certain standards. So again, not really reinventing the wheel here, but more of a consolidation of all our FAQs, revising some of the answers, as well as addressing comments from those 2020 and 2021 proposals. But so again, if your institution does, deal with flood insurance, certainly now is the time to go back through those FAQs and just make sure that your institution is operating as it should under our flood insurance regulations.
Thank you, Robert. Great joke, by the way. So, as I said earlier, we're not done with the CFPB. We're now going to talk about the enforcement action of the month, and that is the CFPB against Bank of America. They issued a $10 million civil monetary penalty against this institution. And you're going to be surprised over what exactly. It was over illegal garnishments and bad processes that Bank of America had to garnish their customers' accounts. You might be wondering, that sounds a little odd because garnishment laws and regulations are generally state specific, and the CFPB is tasked with enforcing federal consumer protection laws. So how do we go about figuring out why the CFPB was the regulator here that we're talking about? Well, they chose to go after BofA as a deceptive and abusive act or practice, or a deceptive or unfair. So that's how they got the specific institution to come under their lens. They were alleging that Bank of America engaged in three primary bad actions. The first one was they had an unenforceable illegal clause on their contracts for the account agreements. And they were basically in that clause saying that the consumer chose to accept all the liability, that no liability would go to Bank of America, that they wouldn't go after Bank of America for improper garnishments. So they were basically taking away the consumer's right to have any recourse should Bank of America do something wrong, which in fact they did, because number two is they were getting a lot of out-of-state garnishment orders. And that simply means if I'm a resident of Massachusetts and there is a garnishment order coming from Florida, you have to see and observe the law of the state in which I live, and that would be Massachusetts. Well, according to Bank of America, they were deceiving their consumers and telling them that the law that applied wasn't my law of Massachusetts. It was the law of where the garnishment originated from, and that was Florida. And so a lot of consumers, they were relying on the protections of their states. For example, Massachusetts is very consumer friendly. We all know that. And Massachusetts prevents you from garnishing your paycheck, certain amount of money in your checking account, because they want to make sure you have enough money to live off even after a garnishment. So if Florida doesn't have the same type of protections for your garnishments, they were observing Florida and taking all of the money from that checking account. And on top of taking your money, they were also imposing a fee called the garnishment fee because Bank of America had to process this. And finally, the third thing that they did wrong is they were not notifying the courts, where the garnishment started, that the accounts they were trying to grab money from were actually out-of-state accounts. So between those three things, telling consumers that they had no recourse, telling consumers that they had to observe different laws than what they actually did, and ultimately not having a good garnishment process, this led to that $10 million penalty. And on top of it, Bank of America now has to reimburse the 3,700 affected consumers over these garnishment fees, which total about $600,000. And the CFPB is asking Bank of America to do two more things. One is to fix their broken garnishment process. So they're going to have to go back, implement the appropriate policies, procedures, controls to make sure they understand what laws truly apply, and to notify these out-of-state courts that the accounts they're trying to grab from are not located in their state. So those things are important so that the customer knows they can go after and fight those garnishment orders. And finally, the last thing, of course, is they're now going to have to figure out how to eliminate that unenforceable clause from the contract agreement. That probably will be the easiest thing they have to do. You just got to hack that because you cannot enforce that clause. So that is our big enforcement action of the month. We're going to go ahead and move on to issues affecting our banks. And we've been talking about this for a while, but it's finally here. We have the Cra Modernization Proposal, and Robert is going to break it down for us.
It is finally here. That's right, Steph. We finally have the joint Cra Modernization Proposal. OCC had done the split from the FDIC and FRB, and then they came back together. So OCC repealed. It's been a long process. And so this is the first, major joint proposal since 2005, which is kind of wild if you think about it, that the CRA hasn't been modified in, over a decade. What are we, almost at 2 decades now? That's insane. So these proposed updates change around the asset size thresholds. And I want to make sure I get these right. Small banks are those with assets of less than 600 million. Intermediate are those between 600 million and 2 billion. And large banks are those with greater than 2 billion. And so additionally, within this proposal, the agencies are amending the retail lending assessment areas. Your institution's assessment areas now include those where your institution has an annual lending volume of at least 100 mortgage loan originations or at least 250 small business loan originations for 2 years. Again, this is to kind of modernize the CRA to account for any sort of mobile and online banking activities that your institution conducts. That way, we're not really skirting the assessment area definition. We're incorporating as long as you have enough activity in certain areas. But with that, I do want to mention that Banks are also able to receive Community Reinvestment Act credit for any qualified activity, regardless of the location. The agencies did say that they're basically going to weigh activities within your assessment areas more. But the important thing is that you will receive some sort of credit if you do act outside of those assessment areas with a qualifying activity. And so the proposal also establishes, 4 CRA tests. There's going to be a retail lending test, a retail products and services test, community development financing test, and also a community development services test. If you're a large institution, all 4 of those apply. If you're an intermediate, it's the retail lending and the community development. And then if you are a small, only the community development applies. However, small institutions do have options of choosing a different test. So if you are under that 600 million threshold, definitely something to look at to make sure that you are maximizing the CRA rating that your institution can receive based on what products and services and where you operate and what loans you offer. And if you do want more information on that proposed rule, little plug here, we do have a great analysis document within the reg updates section of our Ncontracts compliance solution, Ncomply. Definitely recommend you check it out because, again, this is a pretty big change on a major act that hasn't been modified, again, since 2005. And so it's definitely something that your institution wants to look at and comment on if if you think some of the changes may negatively impact your institution.
Thanks, Robert. And I'm glad to hear we're finally getting all of the agencies, like you used to say, getting the band back together. They are, in fact, operating uniformly. So that's nice for the industry. So we don't have 3 different CRA standards. I'm glad to see that. So the next thing we have for our banks is the FDIC released a new process for institutions to be designated as minority depository institutions. To qualify to be an MDI or a minority depository institution, your voting stock membership needs to be 51% or above owned by a minority group. A minority group is defined in the statute as being Black American, Hispanic American, Asian American, or Native American. So if that is what makes up your voting stock majority, you are in the process of becoming an MDI. The other way you can get into being an MDI is if the majority of your board of directors is comprised of minority members and you're serving predominantly a minority area. So again, that 51% of your area that you're serving has to be comprised of minority applicants and members and customers. So those are the 2 ways in which you can get into that MDI. To qualify and to actually go through the process with the FDIC, you do have to write them a nice little letter. And that letter has to have evidence of how you qualify to be an MDI. So you can let them know that you're qualifying under the prong that your voting stock is owned predominantly by minority groups or through the board of directors and minority area prong. So one or the other. And whichever one you choose, you have to give the FDIC a list of either the voting stock, the name of the person who owns it, the percentage that they own, and the minority group they belong to, or a list of your board of directors with, again, the minority group that they comprise and evidence of the area you serve with some of the minority groups that are within that area. So those are the kinds of evidentiary points you have to include in your letter. After the FDIC receives this letter, they will notify you again in writing if you qualify. Once they see your evidence, or if they believe there might be some errors in your calculations or they have questions, they'll contact you for clarifications. Once you qualify, that's great, right? You're thinking, why would I go through the process of creating a very extensive and comprehensive list of everyone who owns voting stock at my bank? Well, there is so much funding available for MDIs and community depository institutions, CDFIs. So MDIs, CDFIs have access to private and public funding that's out there for them. The FDIC by statute is also required to provide technical assistance, training, and other really helpful tools to ensure that you thrive and that you're able to help your communities, especially during economic downturn times, because it is known that these minority communities are generally affected a lot harder than other communities out there. So definitely take a look. If you believe your institution qualifies to be an MDI, that's the new process that you need to follow through the FDIC. And that does it for banks. We're going to move on to our credit unions. And NCOA was fairly chill this month. Like I mentioned, they didn't have a lot to say. they did put out a letter for distributed ledger technology, DTL. And you may remember back in December of last year, they had a notice for request for comment for the industry in which they said, if you're utilizing or thinking of utilizing digital assets or this type of distributed ledger technology, let us know, write comments, answer these questions such as how are credit unions actually utilizing the technology? Why would they utilize it? What are some safety and soundness considerations? What are some risk and compliance issues you foresee? And based on that, I believe this is a continuation of that request for notice. Now they're putting out something for credit unions that say proceed, but with caution. And what is the caution they're trying to tell you? They're saying anytime you're going to go into a new technology, you're going to start offering virtual currency, or you're going to partner with someone that can offer that to your members, you have to take into account and into consideration third-party risk management. You have to take into account the best practices for releasing a new product or a service. And that includes making sure your board is aware of what you're doing, that it feeds into your strategic objectives and goals. So you're just not innovating for the sake of innovation and because it's fun, right? You're doing it because it's serving a specific organizational purpose that's going to help your members or it's going to help your credit union move forward. You also have to consider, is the partner ready to partner with a financial institution? We're a heavily regulated industry. A lot of fintechs out there, a lot of technology companies, they're not necessarily ready to partner with these financial institutions. So that's where your third-party risk management comes into play. Do you have a risk assessment? Do you know what kind of due diligence you need to be conducting on these parties? Do you know about their financial standing so that they are around for a long time if you choose to go with them and they're providing an important service to your members? All of the same process you go through for critical vendors or new vendors, that's the type of process that the NCUA wants to see. They also want you to consider liquidity risk, operational risk, compliance, legal, strategic, reputational risk. So again, what is the onus of this letter? It's we are happy to see the industry move forward in technology and innovation. We want to see that because we cannot be left behind. That's what NCUA is kind of saying. But make sure you don't forget your existing risk management framework and expectations from the agency. So that is the general thing about DTLs and proceeding with caution. We're going to go ahead and move on to our mortgage companies where we have seen a lot of enforcement as well. And Nicole is going to take it away.
Thanks, Stephanie. Definitely a lot of stuff going on about technology. And these next cases I'm going to discuss tie into what you spoke about, Stephanie, technology and also vendor oversight. So recently, we have had two non-bank mortgage loan servicers face major litigation due to data breaches. And like I said, this ties into what you said about third-party oversight, Stephanie, because we know a lot of financial institutions utilize outside servicers to service their loans. So in these cases, we showed that basically the servicers did not utilize adequate cybersecurity measures. The first servicer was Lakeview Loan Servicing, who happens to be the fourth largest mortgage servicer in the United States. They were hit with at least 2 class action lawsuits over a massive data breach that occurred in 2021 that reportedly affected more than 2.5 million consumers as a result of Lakeview's failure to implement adequate cybersecurity measures. According to the class action cases that were filed, Lakeview's customers' names, addresses, loans, and social security numbers were exposed because of this data breach. Some errors that the class action cases cited that Lakeview did was based on encryption. They didn't properly encrypt the data, which they also didn't properly ensure that the data couldn't be unauthorized, accessed by a bad party. But once it was accessed by a bad party, it was not properly encrypted. So the bad party was able to get all of these customers' data information. And then after the Lakeview data breach was reported, another mortgage servicer was found to also have a data breach, which affected not as many as Lakeview, but around 200,000 of their customers across 4 different states. And this data breach complaint, which was against Pangora Loan Servicing, it showed that they failed to protect their customers' PII information, and the breach lasted for about 41 days before the loan servicer noticed it and disclosed it. This is a fairly new data breach case, which also concerns third party because, of course, this loan servicer services for bigger banks and financial institutions. And we still do not know the full scope that this data breach is going to have on all the consumers that were affected. Now, let's switch a little. The next, what I'm going to talk about next has to do with non-depository institutions. So on May 17th, the FDIC approved a final rule that establishes a process by which the agency will identify and investigate any conduct involving the misuse of its name or logo. So the agency says that they have observed an increasing number of instances of such misconduct. So they noted in the final rule that this rule will primarily affect non-bank entities and individuals who are potentially misusing the FDIC's name or logo or making other misrepresentations about their deposit insurance with the FDIC. And along with this, the CFPB issued a related circular regarding deceptive representations involving the FDIC name and logo or information about deposit insurance when this may constitute a deceptive act or practice or become a violation under the Consumer Financial Protection Act. So on May 25th, the CFPB posted a blog which stated that they would be releasing in the future similar circulars to provide guidance for other agencies that have cases that fall under the purview of the Consumer Financial Protection Act and those responsibilities. So what they're doing is pretty much partnering with other agencies, and that seems to be a theme across the board that we're seeing federal regulators working more together on instances where they feel like institutions may be doing consumers harm. So that's all I have for our non-bank mortgage companies and non-bank entities, Stephanie.
Thank you, Nicole. And on behalf of Robert, Nicole, and myself, thank you again for joining us. Remember that everything we talked about here today are things you can find within NComply's regulation updates, guidance, and news tabs. So go ahead and happy researching. We know there's a lot of risk and compliance risk out there. There's a lot of cybersecurity risk. New technologies are bringing it in. So make sure you are keeping up to date, staying alert, and informing your institution of what they need to know. We'll see you next month, and thank you for joining us again.
That wraps up this month's Ncast Regulatory Brief, talking with our compliance experts about the latest regulatory changes you need to be aware of. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thanks for listening.